Hi, everyone, and welcome back to More Than Commas. I'm Cory Shepherd, president of Sound Financial Group, and gosh, what a week it's been in the markets. And I'm only recording this on Tuesday morning, March 10th. Yesterday morning, I started to put an episode together. We saw the market opened markedly lower on Monday morning, and with that drop and all the uncertainty about this conflict in the Middle East and rising oil prices around pressure in the disruptions in the Strait of Hormuz, the S&P 500, NASDAQ, the Dow, they're all down. So I started putting this episode together, pulled away into a meeting, came back about an hour later. The S&P, for instance, had recovered almost fully the whole drop, and by the end of the day had risen further higher than it started. So I re-edited this episode a little bit, but I still think it's because of this volatility, because of these ups and downs, that it's important to check in and also remind you that with everything that's going on out there in the markets, we're really calm here at Sound Financial Group. Even if the markets go down from here in the midst of this uncertainty, we're still going to remain calm. And I wanted to check in with some numbers and some data to both acknowledge what you're feeling and let you know here's our math, here's our evidence for why this is all baked in to the plan, this volatility in the world of investing. This might be what your portfolio looks like right now. This is a 80-20 ETF portfolio that might be very typical for a lot of our clients. And you can see that since March 6th, down, or as of March 6th, down about 2.89%. Might be down a little bit more as of this morning. But I want to remind everybody, this is also what your portfolio probably still looks like. Going back a year, an example of a portfolio was up about 27% year to date, even with this little bit of downturn here that we're seeing, which again feels big in the moment, but in the perspective of the last year, actually feels a lot smaller. So this isn't everybody's. This is one example. Your mileage may vary, but in that bigger context, this is still the picture that we're looking at. Now, we've had other times of volatility before. This is January 2021, which might have been might feel like a similar sinking feeling if you can remember back to that time period. Now, what we didn't know was that the market would very quickly recover. I call this the COVID V because the markets went roaring up after this point. Now, what's going to happen again may not be exactly the same. This is what we saw in 2021, and I know that it won't look exactly like this, but we do know that if we're in a long-term strategy, that markets have rewarded patience and rewarded the ability to hang into a strategy. Now, these are the kind of numbers that folks are going to be talking a lot about right now. This is our energy data from 2023 about where we import oil. Like the U.S. is a net producer of energy. We do import some oil from external countries, but as you can see, the Middle East is a pretty small percentage at this point. We're less dependent on Middle Eastern oil for our direct energy needs than we've been in a long time, maybe 40 years. Now, that doesn't mean that rising oil prices and a potential disruption of oil from the Middle East won't impact us, because it definitely could, for instance, raise the cost of goods that are derived from petroleum that other countries are making that we're importing. So it's bound to have some kind of impact on us, but people are going to be throwing data points back and forth and prognostications, and the reality is we don't know exactly what it means for our overall world economy or for our day-to-day experience, and we certainly don't know what it means for our market-based portfolios in the short term. Here's some data and some evidence from time that I think is more important to dwell on than the data points about oil prices and who might be doing what and where we're getting oil from and what that might all mean. Going back to 1926 and the Great Depression, we can see that on average, after a market has declined more than 10%, which we have not yet seen from any of the major indexes as of this morning. Could be tomorrow, but we haven't seen that yet. But after a market drop of 10%, on average, a year later, we can look back and see that we're up 11.7. So almost back up as far as we dropped. Now, if we go 5 years out, we can look back to that drop and say, oh, we went up on average 9.7% per year after that drop. And in the intermediate period, 3 years forward, we're averaging 10% a year. So 3 and 5 years into the future, most of the time we've more than made up for those declines.
This episode of More Than Commas is brought to you by Sound Financial Group, where we help families and business owners build and protect wealth through clear, long-term financial strategies. Whether it's retirement planning, investment management, or navigating your overall financial strategy, we're here to help guide you every step of the way. To learn more about how we can help you secure your financial future, visit sfgway.com. You can run retirement calculations and download content to read in your own time.
And this is also, I'm not saying that you want to try to get out now to miss some of the drop and then get back in, because that's also really dangerous. This is a graph showing us what it cost to miss some of the best days in the market. The total period between 1990 and 2024, the S&P 500 annualized to 10.6% rate of return. Just the single best day in the market dropped you to 10.2. Missing the single 5 best days would have dropped your return to 9.1. Just 15 days brings us to 7.3, and 25 days out of 25-ish years drops us almost in half. So missing a day a year could rob you of about half of your total rate of return. We don't know when those growth spurts are coming back. We don't know what that timing is, but we do know, as we saw here, that after a big drop, it can come a lot faster than we think. And so this is why staying the course and staying disciplined is really important. And markets have rewarded that over time. Here is a look at all the major events from history. And of course, it's not all of them, but the ones that have risen high enough to stay sharp in our collective memory. We've made it through all these time periods. In fact, my joke is I did some personal research today, and my research has found that over 150 years, no matter the war or the conflict, whatever damage that's done to the market, it has eventually recovered. So if you've got some time in the market, we can find some rates of return. And like I've said before, right, time in the market beats timing the market. And we've got a game plan in place for what these allocations need to do. And if we've done the right work of giving you the right short-term liquidity, cash to get through emergencies and be available for opportunities, then the portfolio is just doing what it's supposed to do. So through the rest of this week that we'll all be watching together, I hope that you can focus on the data that matters the most to your life and the outcomes that you want. And we're always here to have a chat if you've got any questions about that. And we're staying calm over here. We hope you are too. And if you need any help with that, we're happy to talk some more. I hope that you have a great week watching what happens in the market, or maybe not watching it that closely, and that you can get on back to living a great life.